Hello and welcome to CMC Markets Trading Outlook for the week of November the 24th, 2014. My name is Colin Szynski, Chief Market Strategist. Historically, the week of the U.S. Thanksgiving holiday has been a fairly quiet one for trading. U.S. traders tend to go home for the holidays around noon on the Wednesday, have turkey and football on Thursday, and then go shopping on Friday. This year, however, it looks as though we may see an exception where we could see a lot of market action continue right through the week, with a lot of news coming out from around the world right through the week, right through next weekend, and right into the beginning of December. The week starts off with the focus really on the United States. Because of the holiday, a week's worth of U.S. economic releases, and because it's the last week of the month, a fairly busy week for economic releases, all gets crammed into about 2 days. So we'll see mostly Tuesday and Wednesday a flood of U.S. economic news comes out, including a GDP update, Chicago PMI, housing data, and a number of other month-end indicators will all be coming out in a very short period of time that could have an influence on trading in U.S. markets. We also, however, have news coming out from the rest of the world. Throughout the week, we'll be seeing economic reports coming out from Germany that could have quite an influence on trading across Europe. We also, later in the week, have the monthly indicators basket from Japan, which could influence trading in the yen as well as yen-related pairs. And Japan in particular could be of interest this week as we start to get into the election campaign and following the last week's announcement that the country had technically fallen into a recession. We're also looking at potentially a really busy week for commodities. Crude oil has already been active with talk that countries may be starting to cut production. On the 27th, the U.S. Thanksgiving holiday, we actually have an OPEC meeting where they're going to be meeting to set production levels. Some countries have been saying they're in favor, some have been quiet, but that could have a big impact on crude oil trading. Also, as we move not only through the latter part of the week, but into the weekend, on Sunday, November the 30th, there's a referendum in Switzerland on what to do about the Swiss National Bank's gold holdings, because if the yes side wins, it would require the central bank to stop selling gold, to stop lending out gold, to repatriate the gold it's already lent, and to increase gold as a percentage of its overall assets. Now, we've seen some poll results come out that suggest that maybe this won't go through, maybe it will, but regardless, speculation around that could have an influence on the gold market as we move through the week. We're entering the week with a lot of positive momentum across a number of markets. On a Friday and Thursday night, we saw China cut interest rates. We saw ECB President Draghi come out and be even more dovish in his talk about how serious he is about getting European inflation back up and to pump stimulus into the economy. The ECB started their ABS, asset-backed securities buying program, on the Friday. So where we saw that the week ended up with markets absolutely on fire. All of this news ignited European stocks to big gains on Friday. It sent U.S. indices to new highs. It sent gold up through 1,200. It sparked new interest in crude oil. So overall, we were seeing a substantial rally in world markets and a shift in positioning from defensive stances into full-on aggressiveness. So we're coming in with a lot of positive momentum for markets coming into the week. The question is, will they be able to sustain them through the U.S. holiday, or will we see things level off for a while? But regardless, not only do we have the news that's coming out during the week, but we may also see traders starting to position for the first week of December, which also has the potential to be very busy with the usual PMI and employment reports, plus central bank meetings, including the ECB, where people will be looking to see, are they ready to put their money where their mouth is. So there's a lot going on in the next 2 weeks. The U.S. holiday may end up being more of a speed bump than anything else. We'll see, but it does look as though there's quite a few opportunities for trading and for market action. I'm going to start by looking at some of the client sentiment readings, which are quite interesting heading into the new week, as they show some contradiction and some indecisiveness. For example, here I'll start with the S&P 500. We have U.S. indices breaking out to new all-time highs, but interestingly enough, we still have some clients with some pretty substantial short positions against this. It's as though people don't believe necessarily that this rally has the has the ability to continue, and so we do see a pretty heavy short position against the S&P 500. But what I find particularly intriguing here is this split between the Germany 30 and the UK 100. In the Germany 30, we've seen has had a big rally. Clients are net short. It's as though they don't have much confidence in it. However, we have clients here net long on the UK 100, and of course of late we've seen stronger economic indicators out of the UK than we've seen out of Germany. So this perhaps is reflecting that. But it does seem as though there's more conviction behind the UK rally, and people are concerned about the German rally. Looking also at crude oil and gold has been quite intriguing. Crude oil, as we go into what has the potential to be quite a volatile week, clients are net long. The crude oil has been hit pretty substantially over the last while, but it does look as though clients are taking more of a longer term interest. Something that is interesting: all clients 92% long on position size on crude oil. Top clients only 72% long, which does suggest here a bit that among top clients the optimism is a little bit more cautious. What's intriguing also is gold, which had a big run from 1250 up to peaking above the 1150 to peaking above 1200. And look at this in terms of number of clients. We've got people long. In terms of position value, we have top clients actually slightly net short, and but all clients are top clients are at 57% short. All clients at 36% short. So there is a bit of a divergence here with the overall client position still long on gold, while the top clients have been perhaps taking some trimming some profits off the table, or even potentially shorting into the rally, trying to see if they can pick up a correction along the way. I'm going to move now to take a look at a number of charts across the market, and I'm going to start with indices here, and I'll use the pick up with the S&P 500 and where we were going with the sentiment here. So what do we see with the S&P 500? We're seeing that it's had a big rally since the middle of October. It had leveled off a little bit last week, and then Friday, bang, off to the races again. Another big breakout, clearing the 2055 level and trading up towards 2070 with the next round number resistance up around 2100. RSI is overbought here, but the RSI is broken out of a downtrend, which indicates an upturn in momentum. So even though it's overbought at this point in time, there does seem to be quite a bit of money still coming in behind it. So we could see some this week. Perhaps we'll see it pause over the holiday, but certainly it still looks like it's pretty active here. I'd like to show the the Germany 30 now, to give an idea of the what's been going on there. So what have we seen? We've seen it's been recovering as well. Had a bit of a correction. It's taken off again last week, and this is despite the fact we're seeing the clients have been shorting into this rally, but it's actually been breaking out. It's retaken its 200-day moving average, broken another Fibonacci level, and traded up towards the 9,700 level, with next resistance here up around 9,900, and this is 10,000 and change. So we're seeing still some pretty strong momentum with the Germany 30. Now, what we want to watch for as we move through this week is there's a number of key economic indicators. We start with the IFO survey. We have employment. We have GDP. And if we saw signs of a continued slide towards recession in Germany, that could put a cap on some of these advances. So we could see some choppiness in the DAX over the next week or so. Speaking of which, the last major index I wanted to highlight this week is the Nikkei, which also could be choppy with the number of Japanese indicators coming out later in the week. It had a huge rally here, from 14,330 up to 17,560. So that's a 4,000 point rally in a couple of weeks. Just a massive move. It's of course naturally after that digesting things. It's leveled off here in this 17,000 to 17,550. 560 channel here. We could still see some choppiness in that. It got overbought. It's been leveling off here, coming back down, which suggests we're seeing consolidation in the Japan 225. But with an election campaign getting going, and with a lot of indicators coming out, we could see some choppiness in the Nikkei as we move through the week. I'm now going to switch and talk about commodity markets. Commodities have really caught fire in the last week or so, and we've seen probably one of the most active weeks for commodity trading that we've seen in quite some time. So I'm going to talk a little bit about crude oil first, where the speculation has been on whether or not crude will or countries will start to cut production. A number of OPEC producers, particularly Venezuela, have come on side and said they're interested in cutting production. Russia has talked about possibly cutting production, and we never know what's going to happen. So what have we seen here on Friday? Crude oil tried to break out of a downtrend through 76.30. It peaked above 77 resistance and then kind of slumped back. So not quite ready for prime time yet. Looks as though we'll probably see quite a bit of choppiness continue right through the week and heading towards the weekend. Support for crude oil in and around 73.50. So if we call ourselves a 73.50 to 76.50 channel for crude oil, if we got a decisive breakout, measures you up towards 79.50. If you had a breakdown, measures down towards 70.50. The RSI has a positive divergence, so it is telling us downward momentum is starting to slow, and we did see a breakout of a downtrend. So we are seeing some signs of life in the crude oil market, but it does seem a little bit early yet. The looking at the gold market has been very intriguing over the last week or so. As we look at it here, it's been under pressure through much of the last couple of years. Had a steady decline recently, fell down through 1175, but it's picked up support in this 1130 to 1150 zone, and has started to recover. And what do we see? Gold got extremely oversold, so we are getting a technical rebound here up to 1200. But as we start to break, if we start to break through and hold above 1200, would be indicative that we're getting into more of a recovery play. Also, if we're seeing here gold start to stall around 50, suggesting some neutral momentum. But if it does start to pick up from here, you could see gold take, and the signal would be a break through this 50-day average here at 1210. In which case, next resistance is around 1235, and the 200-day moving average is up around 1275. Gold, as I noted, could be quite active through the week on any kind of talk out of central banks on stimulus, and also particularly from the ECB, because of course gold has actually over the last few years been tracking the ECB balance sheet more closely than the Fed balance sheet. It went up when the ECB brought in their first round of stimulus to save the Eurozone. It came down through the stealth taper, and gold has been starting to show signs of life as the ECB's talked more seriously about bringing stimulus back and restoring the trillion euros that they took out of the system over the last couple of years. So gold is at a turning point. If it does start to fail here at 1200, you could see a correction as well. So there is some potential for choppiness, and particularly if the Swiss referendum goes as a no, then you could see a bit of pressure or reduce some of the upside for gold in the short term. I'd now like to move over to currency markets. There's two things I'd like to focus on here. First of all is euro and euro-related pairs, and what the ECB recent ECB comments mean for the euro, because there's been a lot of action in it against a lot of other currencies. And then I'd like to move and talk about the resource currencies and how they've been reacting to moves in commodity prices. So we'll start here with euro pairs, and I'll begin with euro dollar, which is showing some signs of had been showing some signs of base building lately. It's been in a broad downtrend since the beginning of May. However, it has been trying to stabilize here in the 123.60 to 125 range. It had gotten up towards the high of that. It's rolled over and come under pressure on Friday with the more dovish talk out of the ECB. The one thing that's important here, the RSI did not really get above 50, which meant that this broader downtrend has remained intact. If we see it take out this 123.70 here, you could see it fall down perhaps towards around 121.50 initially, with the 120 round number a little farther out on the horizon. Also now to note, the euro against the pound has seen some quite significant action as well. It had tried to pick up, but basically after a big decline through the summer, it's essentially leveled off here in a 77.50 to 80.50 channel. It peaked up and tried to bust out of this channel and failed. It rolled over on the pair. It rolled over on the RSI. Looks like it's coming back down within this channel. It's back under 80. It's just above 79, with next support near 78, 75, and then in and around the 78 even level. The other thing I wanted to highlight that we could see quite a bit of action in this week is Euro Swiss. Euro Swiss is at a very important turning point right now. It's been trading above. The Swiss National Bank has a 120 floor for Euro Swiss, and it's gotten down within a few pips of it over the last week. Now, it's also gotten oversold on the RSI, so there is the possibility for a technical rebound and the possibility that the SNB may come in and intervene to defend this level. So this is really important because if something happens to the euro to take it down, then the question will be: will the Swiss franc respond and go down with it? Will the SNB step in and defend this level, or what's going to happen there? So this could have some significant driving of choppiness in the euro over the next week or so. And finally, I wanted to note euro yen and the two major yen pairs in particular, because there's something very interesting technically going on here. We've had a huge spike up in the yen, a huge weakness in the yen and spiking currencies against the yen over the last month or so as the Japanese economy, people became more serious, concerned about the slowdown, as the Bank of Japan came in with its new stimulus package, and of course talk of an election. So what have we had? We've had a huge run up in this pair from about 135 up to 148, even peaked above 149 at one point. It's a massive move upward, but now where are we starting to see a really significant top forming in the euro yen? We had a big up day to a new high entering another day where it shot up above 149. Then came back down and closed pretty close to where it started. This is almost a gravestone doji here, which suggests a shifting from in control of the market from the bulls to the bears. The bulls were in control. The bears came back in big time. They pushed it all back down. And what are we seeing here on the Friday? The bears decisively taking over. Huge downward candle here, engulfing this previous rally. And basically on top of that, we've got the RSI rolling back under 70 from overbought. That's a technical signal that a correction is getting started. So where could we see initial support? Well, we're back in here under 146. The 10-day moving average here about 145.40, 145 around number, 144.50, and perhaps in around here where there was this congestion in and around 142.50. So we do have some room for a fairly significant retracement in euro yen as we move through the week. The other one I wanted to highlight was dollar yen, which is also showing some signs of putting in a significant technical top here. We're seeing it here. We had a big up day. We also had another day, and similarly here, we had what could be a gravestone doji or a shooting star, but anyways, a sign that we had this big run up and down. It wasn't quite a Western key reversal day, but certainly enough to show that the bulls were really running out of gas here on and that things were starting to turn around, and we're starting to see some technical weakness here. So it got up to about 119. There was a cluster of measured moves around 119.20. And of course a big round number at the 120 even level. We're starting to see it come back. Initial support around 117.40, 10-day moving average in and around 116.50, and this 23% retracement level in and around 115.85. RSI still extremely overbought, so there is room for a pullback, although we haven't had the signal yet. The RSI signal, that rollover signal, that is. Moving now to resource currencies, I wanted to start with, we'll do three. We're going to do CAD US dollar, Aussie dollar, and Kiwi dollar. So I know most people trade the US dollar CAD, but I'm going to focus on CAD US dollar because it's easier for comparison with the other two resource currencies. So what have we had here? We've had the quite a big sell-off in the dollar CAD. Interestingly here, possible reverse head and shoulders base here. We had a test here of 87.80 at the back here in October, ahead where it's dropped down to 87.15, another retest of 87.85.90 here, and guess what? Now it's starting to peak its way above that. It's Canadian dollar on the Friday has broken out of a downtrend. Two factors: not only were we starting to see crude oil improve, but Canadian inflation came in above expectations. U.S. inflation has also been higher. And why is this significant? Because a lot of central banks have been talking about the drag on inflation from the big fall in crude oil prices prices over the last few months. But the one place we're not seeing this happen, we've seen it in certainly particularly in Europe. We haven't seen it in North America. So even despite the drag on inflation from crude oil falling, we're not seeing it in the headline inflation numbers or even the core inflation numbers for the U.S. and Canada. That means inflation pressures in North America are starting to build. This puts the pressure on the central banks to certainly not be as dovish as the other and perhaps become more hawkish as we move into 2015. So what have we got? We got the Canadian dollar breaking out of this downtrend. It's peaked above 89. Its next big resistance is this 90 round number, but significant here, we do have the RSI clearing 50, signaling an upturn in momentum. If we looked at US dollar CAD, we're seeing signs of a top forming and the RSI rolled under 50. So on that pair, it's similarly here we're seeing signs of a bottom. On dollar CAD, we're seeing signs of a top. Now, as we move from the loonie, we'll look now at the Australian dollar, which is basically still base building at this point. It had a big sell-off here in September, another down leg, a washout at the beginning of November. It's trying to stabilize here in this 85.50 to 87.70 range. But what's important here, although we do have this positive divergence and higher lows in the RSI suggesting the downward pressure is fading, we don't have signs of the upturn yet. RSI is holding under 50, so this broader downtrend remains intact until this gets taken out. If we do start to see it clearing up here and clear 87.70, then possible resistance 88.50, then this 89 to 89 and change range where we have a cluster of two Fibonacci retracement levels. The last currency I wanted to take a look at here is the Kiwi dollar, which similarly to its other resource dollar pairs, it's been trading more closely in line with the Australian dollar. Now, what's important with the Kiwi dollar is that not only was this big sell-off here in July from 88 cents down to 77 or below almost 76, was a lot of that was driven by interventions from the RBNZ. The RBNZ was selling it down through this move, so it's quite significant because now the question we ask ourselves as we go into base building is the RBNZ done, or are they prepared to step in again? What have we got? We've got a 77 to 80 cent channel in the Kiwi dollar, and here in October, the one time it peaked above 80, it got knocked down pretty fast, which suggested that perhaps the RBNZ is still looking at 80 as a possible point of intervention. So we've seen it get close to 80, but traders just haven't been able to push it through yet. We're currently looking at support around 78, resistance around 79.40. But what's significant here, RSI got way overbought. It's eased, the downward pressure is eased, and it's actually kind of working above 50. Normally this would be pretty bullish to see an RSI peak above 50, retested as support, and start to move up again. But with the threat of the central bank intervention, where we don't know if they're done or not, you may see it continue to struggle in and around this 80 cent level. If we started to see it move above 80 and the RBNZ not intervene, and you could see the next resistance is up around 81.10. So, what does all this mean for markets? It means that even though the U.S. is having holidays for half the week, and even though of course a lot of them will be out shopping, we'll still be looking for reports from the Black Friday sales in the U.S. There's a lot of other developments going on. There's economic data from countries around the world right through the week. There's the OPEC meeting on Thursday. There's the Swiss referendum. As we move into December, there's another whole flurry of data and central bank meetings through the first week of December and really through the first half. We're heading into a very three weeks or so period for the markets. The holiday may be just a very brief break before, and while we continue to move through this. So it looks like we've got the potential for quite a bit of volatility across a number of asset classes, a number of opportunities for trading.